morning, everyone. Welcome back to Aiman here. Right, so looking at these S&P 500, well, it fell by 0.87% on Thursday's session, finishing the with Wednesday's bounce as the initial optimism surrounding the U.S. Treasury buyback operation faded. So I think while the Treasury Department, decision to double its long-dated debt buyback, the initially pulled 30-year bond yield of the 19-year high above the 5% ish. So I believe that um, the long and yield reverse higher on Thursday as well. And also looking at the equity market, right? Well, it came under renewed pressure following the disappointing retail guidance from the Walmart and also persistent inflation concerning in the Fed Reserve latest minute meeting, and also the Treasury Secretary Bassan confirming imminent economic action against Iran, right? Also, well, if you look at the S&P 500 sectoral performance now, well, the divergence between the S&P 500 sector on yesterday's session, right, reflect a classical defensive rotation paired with the commodity risk play. Well, if you see here, right, the energy gain traction as the WTI move higher, while the real estate sector attracted a yield-seek safety bid following the buyback announcement amid a sharp tech and also consumer uh, pullback. And looking at the China A50 futures, well, it pulled back on yesterday's session by 0.55%, diverging slightly from the onshore bourses where if you see here, the Shanghai Composite Index, well, it edged up by 0.24% to close at 3903 points. So I believe the dip in the large cap futures was driven by the profit taking across the mega cap banking and also the Cedar Enterprise, and also some of it are heavy material counters following the recent multi-day gains. So also conversely, if you look at this onshore market, well, it shows somehow resilience in the mid and small cap growth sector, particularly in some of the goals, right? The biopharma, and also some of it coming from the tourism sector. And looking at the WTI crude oil futures, well, it surged by 2.9% on Thursday session to settle higher around 86.8 $3 per barrel, hitting its highest level since July. So I believe the advance or the sharp uptrend, right, was triggered by the escalating tension after the missile alert sounded in the UAE, and also Trump formally announced a sweeping economic welfare sanction campaign against Iran. So I believe that the news erased the initial market concern over the expanding U.S. Crude inventory. Also, investors are now cooled down after Bassan say that in his statement, right, that U.S. likely won't start a large scale against Iran, large scale combat or large scale war against Iran, as it could hurt the economy itself. And also following yesterday's move, well, it has crossed above our stop loss level, and now we are looking into a positive trading bias, with our resistance remain solid at $91 per barrel. Now, looking at our local market, local Malaysia market, right? Well, the FMKLCI, well, it advanced by 0.31%, to close at 1736 points on Thursday session, while the FKL futures rose by 0.46%, maintaining its solid upward momentum. So if you see the KLCI was propelled by easing of the U.S. Treasury following the U.S. announcement, um, which boosted the global risk appetite as well. So the local market activity, I believe that it was heavily led by the um, data center and also infrastructure news headline by the YTL Power, right? After surging. Uh, After announcing the gigawatt scale data center development, alongside with strong buying in those construction and also plantation heavyweight as well. I believe the overall market turnover expanded yesterday. And if you look at this sectorial heat map, right? So this shows uh, or this reflects the data center team driving yesterday's session, led by massive surge in the utility sector, like YTL Power up by 5.7%, YTL by 9%, right? And also some of it coming from the industrial services um, sector here as well, following the gigawatt scale project announcement. However, I believe the overall index upside was kept in check by um, sharp profit taking in some of the process industries, um, and banking heavyweights like Maybank, Public Bank, right? Of course, yeah, I believe when talking about the DC and also the infra theme, which drive the market yesterday, the DC and also AI infrastructure holds um, for different sector across Bursa Malaysia. So some of it coming from the utilities, construction, um, and also property development, right? And also M&E as well. So yeah, um I list it up. I list it out for you today, right? And I mean, there's a lot more, but to me, this is one of the most significant ones, lah. So can monitor this moving forward, right? So talking about our Malaysia trading stocks. So today we have Pakat Group. So the stock is on its breakout formation higher at RM1.90 level on a strong volume. So with that, we expect the momentum to keep bullish, and the stock able to propel higher towards RM2, followed by RM2.10 for the second resistance. And also, if the stock to clear below the RM1.80 support, well, this could reverse the course and trend lower. Also, next, we have next G, right? So the stock is experiencing a solid breakout as well at 32 cent level. So if the stock remains bullish, you expect the price to reach 35 cent in the coming session, followed by 38 cent for the second resistance. Also do keep an eye at this 29 cent support for any attempt of reversal. So today we have two breakout stocks, which is Pakat, and also we have NextG, right? So do keep this both on your watch list. And looking at the FCPO futures, well, surged by 1.35% yesterday, right, to close somewhere around 4959 per ton. Uh, breaching above the 4,900 resistance level yesterday. So I believe the momentum was propelled by the confluence of research upgrade in most of analysts has upgraded their forecast alongside with a sharp rally in the peer edible oil futures. Also, I believe the upside breakout was further sustained by firm global crude oil pricing and also structural demand expectation as Indonesia prepares to end the B40 transition period in September ahead of a higher biodiesel blending uh, target, right? So for now, we are targeting 45,100 and also 5250 for the second resistance, and our stop loss remains firm at 4530, right? So that's all from me, and I pass the floor to the next presenter. Thanks, everyone, and happy trading.
All right, good morning, everyone. So today we have a results review for the first half 2026 results for Taliworks Corporation, whereby the core net profit for the first half of 2026 was at 20.5 million ringgit, which was about 15% year-on-year lower. And in terms of meeting our estimates, it only made 23%, but of our full year estimates. But you have to understand that there's potentially some, toll government compensations in the range of between 40 to 60 million ringgit, which could likely be, seen in the second half of this year. So we view it to be in line. In terms of results, the water segment was pretty solid. EBIT grew by 28% year-on-year due to some additional water demand supplied to the Bukit Gasing distribution pipeline. Toll was a bit, for its Grand Saga Highway, was a bit low, given that there was some traffics that were diverted to EKVE, and the construction arm, which was involved in the Sungai Rasau project. Well, that has reached about 44% completion for package 2 and 24% for package 3. And our revenue from construction heavily grew thanks to the better progress. So, all in all, fundamentally the stock remains quite stable. Just to bear in mind that the company is seeking to preserve more cash, and hence dividend payouts are likely to be not as high as before, and we view the strategy to be reasonable, in an event for them to preserve cash in order to expand on whatever businesses they have. So all in, maintained by with a new target price of 70 cents. Any upcoming catalyst would be from them potentially winning any new water projects, namely your Rasau Package 2 or any other projects such as Langat 2 Phase 2. Yeah, so that's all about it. I'll stop here and pass on to the floor to the next speaker. Thank you.
Hi, morning. So I will have a results review on Dayang. So Dayang has delivered a first half FY26 core net profit of 57.2 million ringgit, coming in below ours and consensus expectation at 25% and 33% of full year forecast respectively. So the shortfall was mainly due to weaker than expected revenue stemming from fewer work orders and contract conversion under topside maintenance contracts, lower vessel utilization, and reduced third-party vessel chartering income. So results reviews wise, revenue declined 39.7 year-on-year to 161.2 million ringgit, mainly due to the fewer work orders and contract conversion from oil majors under topside maintenance contract. So this was compounded by lower vessel utilization of 58% compared to second quarter FY25, 64%. So a significant decline in third-party vessel chartering income and weaker ancillary income, particularly from the catering, mobilization, and demobilization activities. So operations were also affected by disruption involving one of the group's work boats. As a result, core net profit fell 37.4% year-on-year to 35.7 million ringgit. So looking forward, FY26 earnings likely to remain soft, but weakness appear timing related rather than structural. So the postponement of shutdown activity is expected to weigh on FY26 earnings as oil majors prioritize sorry. As oil majors are prioritized in production continuity, resulting in fewer work orders and contract conversion. However, management indicated that the deferred maintenance activities have not been cancelled and could be pushed into FY27-28. Hence, we view the current weakness as largely a timing issue rather than structural deterioration in the Dayang's maintenance franchise, with the group's order book to remain healthy at 4.7 billion ringgit. So we have slashed our FY 26 and 28 earnings by 65.4, 10.9, and 5.1 respectively, assuming lower topside maintenance activity and deferment of shutdown related works. So we also lowered our valuation multiple from 12 times to 10 times FY27 PE, reflecting the weaker near-term earnings outlook and reduced visibility activities level, with 10 times representing the 5-year mean. Accordingly, our TP is lowered to 1.78 cents. So despite the unexciting near-term outlook, we remain constructive on Dayang's medium-term prospect, given its sizable order book and the potential recovery in the deferred maintenance activity from FY27 onwards. So our TP incorporates an 8% ESG discount based on Dayang's ESG score of 2.6%, 2.6 versus the country median of 3. So the downside risk includes slowdowns in the new work orders, weaker oil prices, and higher operating costs. I think that's all from me, and maybe that's all from us as well. See you in Morning Kappa next week. Have a happy weekend. Thanks.